Well, welcome to our. Can I introduce?
Yeah.
Or if you want, it doesn't matter. But, okay, so welcome to our penultimate session. We've got three eminent speakers who are going to share their insights and guidance on how we're going to deal with the post pandemic, and particularly on when it comes to.
Is there anything I'm missing out on here?
Commercial property and so on and so forth. So I'll hand over to Robert, who's going to be the moderator. We look forward to hearing what you've got to say. Thank you.
Lovely. Thank you, Chris, and good afternoon to everyone. So here we've got Hassan and Kazim, who will talk through their insightful views and what have you on probably one of the most important and prevalent topics of the day, which is, of course, the pandemic and the impacts, the long-term impacts of the pandemic. And we're also throwing a little bit of Brexit too, which is everyone's favourite second subject now. So perhaps if I turn to Hassan first, perhaps a quick introduction, and then is this pandemic the death of cities?
Hello. Yes, my name is Hassan Farran. Sorry about the technical problems initially there. So I've been working with real estate in the UK for the past 10 years. I'm currently working for a company called Cushman and Wakefield. We're a global company based out of the US, and we have a very big footprint on the capital market side in the UK and elsewhere. To answer your question, I don't think it's the end of cities in any way. I think history has shown us that we will be loyal to urbanization, but I think we will see some changes in the way cities look like in the future, and I think this pandemic will probably have accelerated that trend.
I think that's absolutely true. The fourth industrial revolution is definitely upon us, even if the headlines are more prosaically about cases and death and that kind of thing. But Kazim, what are your thoughts?
I think I'll give a brief introduction. I'm Kazim Koseoglu. I've been doing real estate for over 11 years, started in UK, and I run one of the family office-backed real estate companies in Turkey called Esas Properties. So my feeling is, this is going to pass, but it's going to have an effect that it will have a spillover in terms of how we live, how we transport, and many other areas, how we shop. So it's going to be a new environment with some spillover. So different asset classes will have different effects. Different cities will be affected differently, but it's going to be something that could not be seen, or it's a black swan event, basically. That's all I can say. So we're going to have new ideas flying around for the cities.
Okay, yet another black swan event in the past 15 years. And how does that affect, focusing on London specifically, how do you think that's going to affect things like office use and office space, and then also the population and commuting and how people kind of live, Hassan?
Well, I think what we've been seeing recently is where people are working from home, not going into the cities. I think it's sort of it makes you think about ideas around the sort of 15-minute city where you have the work, leisure, and the home or live within the 15-minute walk or cycle. People are shying away from public transport, which undoubtedly will have an impact going forward in the way urban areas are put together. In terms of how the future office, I mean, it's a very much talked about topic, and the predictions were dire around the future office initially during this pandemic. But we at Cushman Wakefield, we've been doing a lot of research on this topic, and we have analyzed 4 million data points from around 50,000 workers from over 99 countries around the world. And what we found was that whilst productivity and collaboration both remained positive and improved during the lockdown with the remote working, where we saw a significant and sharp drop was around the well-being, personal development, and the corporate culture really suffered during this time. And it is for those reasons, I think, the office being such an important part of a corporate identity will remain, but it may change in how we use the office. But I think in the short term, the social distancing we have to do will offset any sort of expectation of sharp reduction in the office use or take up.
And I guess the sharp shock of us all having to learn how to use Zoom and what have you played out a little bit this morning. The Crown Estate had to write down £500 million worth of its property in central London. Kazim, are you sort of feeling and seeing the same sort of thing?
I think there's two different opinions, and I would say the values are very difficult to value today. I mean, if I wouldn't want to be a valuer in one of the big 4 or 5 companies because there's no comparables. Secondly, the interest rates are so low, and they're going to continue to stay so low for so long time. I think it's going to be at least 3-4 years at 0 interest rates. And I think the first shock, people were really scared. Now people are looking for the investor, from an investment perspective, the yield. Everybody's chasing the yield, and London is one of the top 2 markets in the world, top 2-3 markets where you can really be, that office space really means something. And I totally agree with Hassan. It's the cultural thing and creativity that those offices will be continue to need. So you might have a $500 million write down. In 6-8 months, you might have that might be back to 0. The biggest example, in 2008, we were looking at a deal called Broadgate from British Land, and 3 years later we were number 2. So another fund bought it. So 3 years later, it was sold at such a high price. Once that fear is out, people will continue to search the yield, and London is one of the few places where people are very comfortable with very low interest rates to find those yields.
Yeah, absolutely. I think low interest rates are going to be here for a very long time, and we've already had low interest rates for sort of 10-12 years, and there's no real reason to expect them to go up soon. They may even turn, of course, negative. What do we think is going to happen then with projects that are on the table at the moment? So talk a little bit about repurposing of buildings, but are you likely to see projects that have got planning permission shelved for the time being? What do you think is going to be the sort of the next 6-12 months, Hassan?
It's a very good question, and to pick up on Kazim's point, there isn't much evidence yet to sort of point to a trend. Clearly, if you're in the development business, you're going to take a different view on rents and rental growth compared to 9 months ago. There are more uncertainties around how much space you can get away to individual tenants who normally would be able to predict quite accurately how much space they would need. But I do think that the development side will continue, and we have seen evidence of that by 14 Leadenhall in the city, where they've pulled the trigger on the 900,000 square foot development. So development is definitely not dead. It will continue. The pace of it may not continue at the same rate, but there is the attrition of office space, and the renewal of the city will continue in that sense.
That's cities rarely die, do they? They evolve and become bigger and better. Looking away from London, and it ties into the idea of the 15-minute city, which harder to replicate in London, of course. Kazim, do you see opportunities outside of London, or are you naturally gravitationally pulled towards London because of its sustainability?
Robert, we started investing outside of London in 2009. So our first investments were outside of London. Now, I think there's two ways to look at it. When you go outside of London, you need to be comfortable with UK, because UK is not London, because most of the people only, when they visit London, they vision the whole UK is like this. But there are other very good cities with growth opportunities, such as Manchester, Birmingham. But you know that yield compressions and liquidity will always first happen in London. So if you're going to be a first-time buyer, you know, you just want to be more conservative. I think London, even for low returns, is better because liquidity is better. But after 2, 3, 4, 5 deals, you get comfortable in, to be honest with you, for us, we got comfortable in Manchester, Birmingham, we bought and sold buildings. So I think there are other pockets where you really, the growth is there. If the oil prices are high, Aberdeen is a great city to invest. It's very, you know, I know it's very cyclical, but if you're at the right time, at the right place, you'll make a lot of money. But the biggest problem for the first-time investors will always be being more conservative and liquidity, and that's going to be London for lower returns. But we're investing outside of London a lot. So we have invested in Middlesbrough, Barnsley, we bought and sold shopping centers. So I've been all around. So there are opportunities, but I would start from London for a new investor.
And so are you saying then, you know, this pandemic, which we estimate to be, you know, a third of the way through, certainly not over halfway through, is something that will come, go, pass, and things will revert to some sort of old normal? Or will there be some significant changes that will then be baked into the property world?
Well, I suppose there are new sectors that will surface as more attractive in the future, I think, and we've seen a huge spike in demand for data centers, for example. Cold storage is another one. If you want to look at things that are slightly off the beaten track, but there are certain sectors, and including life sciences actually, that has, on the back of this pandemic, seen a huge increase in demand, and we are feeling a lot of inquiries where investors are looking to get involved because they see those as very defensive sectors and inverted commas future-proof. So those are examples, I suppose.
Kazim, is that your?
Robert, could I just make a comment there? I mean, you asked the question about, you know, to London. I mean, as far as what we try to promote together with our England investment team in DIT, I mean, there's lots of government incentives outside London, and you know, if you look at Northern Powerhouse, if you look at other areas, and particularly in the tech sector, I think there's more opportunity for property development and people moving into areas where that tech capability is located. And a lot of that is in the north of England and the west of England. So, if you're in the tech sector, I think London is not the centre of gravity anymore. And a lot of people are now moving out and looking at areas in the north and Scotland as well. Anyway, just a point I'd like to make.
Oh yeah, absolutely. The UK isn't just London, definitely. That's a great point. Shall we throw into the mix a little bit about Brexit as well? Clearly, negotiations are at yet another stumbling block, and these things take. There's a deadline, but these things are taking an awful long time. As that for international investors, is this a buying opportunity, or do you think this is a watch and wait? Kazim, what are you seeing from your side?
I always, for us, it's always been a buying opportunity. We bought a building in 2016, 2 weeks before the referendum, when most of the people were asking me, why are you buying? I said, well, you're gonna be in EU or not EU, but at the same time, we don't have any competition to buy assets. So, family offices maybe have this advantage. They have a longer hold horizon, and people are less, political risk is not a real risk in terms of if you have a 10, 15, 20-year investment horizon, to be honest with you. Again, we bought a building right before the vote of Theresa May's bill in 2018, December, 10 or 11th of December. So, I see this more of opportunities, but what I have to say is you don't expect to make money in 2, 3, 4, 5 months. you have to make sure, your fundamentals are right, your cash flows are covered, and then you can live for 2-3 years of uncertainty. One thing is for sure, the prices don't go down even under these circumstances, but you have less competition. So I would never say we got a 10-15% discount because of Brexit, because market doesn't allow that. But you don't have 10-20 people bidding. Suddenly you have 2-3 people bidding. And if you have done deals before in UK, you have that advantage. So for me, I think it's an opportunity. And you can't. I mean, if you should have a longer horizon than 1-2 years on these type of assets.
Oh, definitely. Yeah. I know sometimes the theory is long term, but the clamour is for short term gains. Hassan, perhaps from a slightly different perspective, with from your business, are you seeing the same sort of thing? Then is it very much it is a buying opportunity, especially with a slightly depressed pound?
Well, I think it's an interesting point that Kazim is making, and I mean, if you look at London as an investment destination, it traditionally is between 70 and 80% of the investment volumes that happen each year are overseas investors. So it's hugely reliant on investment from overseas, and for many of them who will be risk averse, will take a view that we might as well wait a little bit for more clarity in the market that has a degree of uncertainty around Brexit, which clearly presents an opening for investors who would like to invest, and especially first-time investors who would have an easier time getting a seat at a table in a market which is less congested. So I think it does present an opportunity. The exchange rate, whilst that will rarely be a driver for investment, but yes, it can be the sort of icing on the cake, if you like, if you can get a bit of a discounted exchange rate that will boost your returns.
So you and Kazim are very much the same thoughts there. Kind of there'll be fewer people looking to buy, but still it's a worthwhile asset to be bought.
100%. I mean, if you take a view across the globe and if you look at across assets in terms of returns, we can talk about what the prime yields are doing in Europe, but London is looking relatively attractive comparatively.
One thing I'll jump in. I said this 2 years ago when Europe is trading at 2%, 2.5%. Paris, Berlin, London looks very cheap.
Yes,
looks very cheap, and I still think with these funding interest rate levels, it's still very cheap.
And do you think, just moving aside a little bit, will future purchases be more highly geared or as geared as possible, with interest rates being low and perhaps even moving into a negative space? So, of course, you won't feel a negative interest rate on your debt, but are you guys going to be looking and seeing more deals where you're as leveraged as high as you possibly can be, or do you think some of that risk could be taken off the table?
I think from an investor perspective, there has to be I think you need to put 35 to 40% equity in each deal. In 2008, when the global financial crisis happened, the interest rates were very low, but the banks were very conservative. It's the same here. I don't think even for core assets, you might go for 60, 65, but these are very cyclical assets at the end of the day. You don't know when that black swan event is going to hit you, and you might need time. So some people will gear it and they will make a lot of money. Don't get me wrong. Some people will gear it and they'll get burned. I don't want to be both. We're not greedy in making money. So we would want our equity to make decent returns, 8 to 12% IRRs, and we're happy. If we gear 10% more, probably we'll make 20, but next time we might lose all our equity. So I think it's better to be conservative, not too conservative, but 60, 65% leverage should be, I think, ideal, even if the interest rates are very low.
Yeah, and I think even if investors aren't as prudent as Kazim is, I think the banks are also much more restrictive on what sort of LTV they're offering. So we're not, and as a result, at the moment we're not in a credit crunch that we were in 12 years ago. it's a very different scenario, and it's much thanks to the banks being more conservative on their lending. So I think whilst you'd be tempted to try and boost it, but you probably won't find that sort of offering unless you start paying for it through sort of mezz or bridge financing, that sort of stuff.
Mm-hmm. If circumstances won't allow, then I guess we're yes at 30-35% equity. What's turning quickly back to COVID? So, and this ties in with Hassan's mentioning of the 15-minute city. What are the 2 or 3 main things your main differences you'll see with the way people are interacting in cities and offices that will have the biggest effect on asset prices? Or will it be, well, there'll be changes, but actually it's not going to make a huge amount of difference at the end of the day? What do you think, Kazim?
I think in the offices, in the long run, it won't have an effect, to be honest with you, because the companies will need more space because of a different use. They're not going to put more people, but they're going to have the culture, events, entertainment there where they can put it together. In terms of different asset classes, it's going to be a different effect. So on retail, I think the retail landscape has changed, will change, and continue to change. So even people who've never done online shopping, market shopping, they will continue there. So I think multifamily, which is called PRS in UK, it's called multifamily in US. So that type of product is going to be very interesting. What I think about these 15-minute cities, the key here is the products. We don't have enough products that people used to invest in. So retail is out, hotels nobody will touch, offices people are scared. So this industrial and multifamily will be very important for these 15-minute walkaway cities and destinations. That's how I look at it.
Hassan?
Yeah, no, I echo some of the points that's been made already. I think it'll be a new. There'll be a new focus on certain ways of doing business, but the fundamentals of people meeting people to do business will very much remain. There are no shortcuts to that. But in terms of how people utilize office space may change in terms of working from home, clearly working from using the office corporate office space as a place to meet and place to collaborate rather than sitting and working, and also using other parts of other venues to work, whether it's a cafe or a serviced office in your suburb of Wimbledon or where I live in Berkhamsted, to sort of differentiate and use it becomes of a multifaceted office space use. And I think that also will be reflected in society. I think, as Kazim mentioned, the online, the e-tailing. I mean, it took UK about 10 years to move towards 20% use of online shopping. That has now gone to 30 in the span of 6 months. Clearly, there's been some massive shifts in the way people use technology and interact. And while some of them will revert back to some extent, I think we've also created some lasting change. And I think the way we work needs to just catch up with those changes.
Oh, very much so. I mean, I see all the time people looking to change not how they work, but also how they live, and trying to using this pandemic as an opportunity. So am I right in saying that the views from your expertise, your joint expertise is, if I've got an amount of money to invest into the UK, firstly, don't be London centric. There are plenty of other places with or without tax benefits, but that perhaps we should be looking towards, data centers and refrigeration, as you mentioned, life sciences, that kind of things that are off the beaten track traditionally, and steer clear of offices for the time being?
I wouldn't say stay away, to be honest with you, on my side. It depends on what kind of return. If you have a 5-10 year return, at least 5 year time horizon, and if you have a long lease, a good covenant, it's still, I think offices will come back. But if I had a choice, I would go to industrial or multifamily, basically, or alternatives, as Hassan just said. These are more COVID-proof, basically. But there you have to pay the price. So you're not going to get a discount on industrial warehouses when the corona hits and everybody wants more of these. So I think it's a trade-off between return and your expectations. That's all I would say.
Yeah, I think what I would say about offices is where we're seeing strong demand and interest is for the long let, very strong covenant type investments, and whether it's in London or outside, but where the view is that you can buy that and your income will keep on rolling in through any downturn or future pandemic. So in that sort of segment, that slice of office investment, we're seeing pricing, in fact, hardening compared to previously. But resi, absolutely, it's a very difficult sector to get into. It's not cheap. It's a defensive investment. But if you can get in there, you're in a sector that is young compared to the equivalent in the US. And I think it has lots of things going for it. And the logistics, where we've touched upon earlier, I mean, it's very attractive at the moment. I mean, Amazon, to give you an example, has taken more than 10 million square feet in the UK alone this year. It's on track to be the most busy year ever in the logistics sector in the UK. So clearly it's attractive. But pricing is also tight as a result. But I think there's still mileage in that sector. So if, as a core investment, risk averse, that's where I'd probably be looking.
Maybe Robert, just to add one more thing that we've looked a lot, senior living in UK. I think it's going to be a very interesting market because UK is also behind the curve in senior living. But for that you need another expertise. So I think all these alternatives need different expertise. It's not very straightforward.
But I think overall, I think absolutely right. Living space for the elderly and making sure that communities can evolve in that space is where there's great growth. But you're right, way beyond the context and scope of today. But I think the key thing is it's not all doom and gloom. Between the two of you, I think a lot of positivity there. So we'll carry on regardless of pandemic and Brexit.
Absolutely.
Absolutely. Thank you.
There you go. Chris, I think it's back to you.
Yeah, well, you've actually got a few. No, you're right. You're right on time, really. But yeah, I mean, it's a very interesting area, and the topics you've discussed, what we're facing today and what we're going to face in the future. So, but I do believe there are going to be major shifts, and there'll be a lot of organisations. I mean, digital transition is going to have to be embedded in all sectors. I mean, if you don't do that, then you're going to get left behind. I think when it comes to design and build of commercial properties, all that will have to be a prerequisite in terms of what that functionality of that building is going to be. So, and that's going to get expensive as well. There's going to be an on-cost there, I'm sure. So, but thank you for your contributions. I mean, it's been very interesting. I've been listening to it intently, and I'm sure you'll be at the forefront of some of the changes and some of the benefits as well as we get through this COVID crisis. So thank you again, and we look forward to seeing you again soon. Thank you.
Thank you. Thank you.
Thank you.
Stay safe.
Thank you.